before I introduce everybody, just one question. Anybody got cash flow problems? Nobody has, we just leave, we can just go. Don't worry about it. I think everybody does these days, and that was the reason we decided to have this event. Was because it seems to be worse this year than ever, obviously, and we wanted to be a positive night, but we've just come through the whole COVID thing. As business owners, we've pivoted our business, and then Labour got in, and we've had a lot of changes, and if anybody's going to bring us down with the negatives, it's poor old Emma tonight, and then I'm going to tell her it's all positive. So we're just going to introduce ourselves first, and then we're going to talk a little bit about the problems, mainly in construction, but it's not just about construction tonight because we work with all clients, but it was very heavily focused on construction. So we're going to introduce ourselves and then talk a little bit about those issues and give you some, hopefully you'll get some tips out of there. But please do feel, like jumping in and asking questions as we go. That's the idea, is a bit of a panel. So that means not gonna work. There we go. There we go. Okie dokie. So firstly, can you see me if I sit down? Maybe not much difference. Just a little bit about myself. So I've been in business all my life, so I've not been in finance, only been in finance really in the last 10 years. But I was in photocopiers for 20 years. I built a business, started actually working with Xerox corporate. And then I went back to Ireland, which is where I'm from, in Dublin, and built a Xerox dealership. I was talking to one of the lawyers here tonight. I was saying, I built that organically to about 2.5-3 million turnover, and then I thought I could do anything, and I bought another business that was similar size, and it was just vanity project really, because I thought, this would be great, it's so easy, and it nearly killed me, and then I got it to about 7 million, and it did kill me in a breakdown, and it was just a really drunken weekend with a load of girls in Spain, and I went, I'm selling this business, and I got out. So I have a lot of experience in acquisition, and therefore, hence why I work with a lot of accountants who help businesses grow through either organically or acquisition as well. But about 10 years ago, almost going on 10 years now, I was asked by a firm of accountants to become their sales director actually in a finance brokerage, and I thought, well, I don't know anything about finance, why would I get into this? But I looked and I thought, you know what, I think in 10 years you will see the high street banks close, you will see them not lending. I could see this world of alternative funding, and I did a lot of research on it, and I'll talk later in the night about what that actually means. So I took the job, but I didn't last long. You can imagine I've worked for myself for over 10 years, so I knew they were going to sack me, so I better go and set up on my own. And I did, and I launched Lender Made Simple. But then 5 years ago, people were saying to me, look, you really, you do make it simple to find finance. You don't talk jargon, you make it quite easy. Do you do, mortgages? Do you do pensions? Do you do foreign currency? All these other elements of finance. So I launched a business called the Finance Hub, and I brought those experts in under the one roof. And at the time, it was a physical space. Spent a fortune on a beautiful office in Tunbridge Wells, and we held loads. We held 70 events in 2 years, I think, educating people on finance. And then I just felt Tunbridge Wells was a bit small, so I took an office on in here, and I can just rent the space out when I need it in this auditorium, which is great. But only yesterday, and there's a man sitting up there in the back. I don't know why you sat on your own up there, Doug. So only yesterday we took that digital actually, and I've known Doug many years, but his business partner has been my best friend for 10 years, and they build platforms. And about 6 months ago, we sat and we went, we've known each other 10 years. Why do we never build a platform? So we built an amazing platform that takes that Finance Hub digital, but still with the personal element. So, AI, we all like, well, we like it or we hate it. I think if you were Googling, find me an accountant or find me a financial advisor, AI is going to grab that and sell it to whoever. So what the Finance Hub platform is going to do now is effectively allow us to work with our partners, our accounting partners, to white label it onto their website so they can offer those services in a controlled environment, and their clients will get a login and they could say, I want a will, I want a business loan, I want a mortgage, a commercial loan, whatever it is, they can click what they want and they know that they're trusted advisors in that safe environment. So we launched that yesterday and here today, so it's not been a busy week really. So I'm going to move on now and stop talking about myself and move over to Steve Taylor, our first...
Do I have the clicker or do you keep it? You keep it.
So the first of our speakers tonight,
Thank you.
Steve from Bibby. I'll let you speak up.
So I won't read it word for word, but I've been at Bibby for, oh goodness, second stint, looking a bit further down, 3 years. Someone put up there that I've been in invoice finance for 13 years. I thank them because you've got to add another 10 to that, so it's 23 years. And after the football yesterday, I'd aged a further 20 years. But we ain't going to talk about football. So yes, that's what I do. I've worked for a number of different banks that offer invoice finance services, but in terms of what we do, it's very much around the construction side, and that's what we're here about today. So a little bit about Bibby. Been trading in invoice finance since 1982, so a good stint. I think we know what we're doing, and we work in different parts of the world, 9 different countries, supporting working capital and cash flow support to many different businesses, even construction included. We're there to help businesses grow, thrive, and just generally survive. And again, within construction, we're finding it very difficult at the moment. So to find an option out there that a high street bank won't give is absolutely spot on, and it just gives these businesses that little bit of help. And as you can see, Bibby have been trading since 2017. Oh, it's gone.
Sorry.
Oh, it's gone.
Do you want me to go back?
217 years we've been trading. Yeah, we know the markets very well indeed. But yeah, that's our background. In terms of what we do, we've got 27 offices around the world, 9 different countries, over 1,000 colleagues, 64,000 debtors. So that's the customers of our customers that we work with. We fund 1.3 billion at the minute, so that's our customers with their customers. 11 billion in debts factored, so again that's the invoices in which we're funding. 8,500 clients. Trustpilot is off the scale, so please have a little look at the Trustpilot reviews. Myself and Ben are on there, so yeah, it's worth having a look because you can see what we're all about. And more importantly, the last bit, 10 million raised in fundraising events, and that's over the 40-year period. So that's us donating a day, that's us doing local events, and the nice thing is Bibby match the events that we're putting on. So just gives you a little bit of a feel for what we're doing in the local areas as well.
I think you are the only people lending in construction at the moment.
We are, yeah.
And when construction people come to me, it's always the no with a lot of lenders. The first thing they say is we don't deal with construction. So you're now the only ones out there that will do that.
We are.
And I've seen this year, and as I said, we'll talk more about the products later. I've done more invoice finance this year than the 9 years I've been in business. So that shows that there is a real cash flow problem out there.
And to take back from what I was saying earlier, sorry to interrupt, what I was saying earlier was the fact that the banks, they go to the bank will say, okay, what industry are you in? I'm in construction. There's the door. There's the door. Yeah. And these poor businesses have no idea, no options, no path as to which way they need to go. Mm-hmm. So they come to us. We're delighted to help.
Yeah, thank you. Emma.
Yes, so hello, I'm Emma White. I'm actually co-managing partner of A4G Chartered Accountants. So we tend to say we're business advisors first and accountants second. So we work with a lot of growing businesses often we're people's second accountant, where you've had a first accountant, you're trying to save on fees a bit and you're just trying to tick the box. We are often the second accountant because businesses are looking to transition. So I quite often go in, and it's probably the bit that Steve and Gillian know I love the most, where I'll roll up my sleeves and help them set a plan to tidy up their financials so that they actually mean something to businesses, rather than it's just something that goes in for the benefit of ticking a box at year end, so that they can actually use it to solve problems in their business. I actually joined A4G as an 18-year-old trainee who just wanted to earn some money rather than share a bathroom at university. So I wanted to live with my mum. But obviously been pushed and pushed. So our founder, I would say, has pushed me outside of my comfort zone every year for 27 years, to the point where now I've pushed him outside his. I get to make the decisions. I'm joined tonight by one of my business partners as well, Joe. So we've worked together for a number of years. I'm pretty sure I own the rights to his firstborn child as well. we do have amazing, and we have a policy of recruiting from 18 every year. So we've got 5 trainees joining us in September. We've got really high retention rates, so we all tend to grow together, and it gives consistency and support for clients. It's quite nice for them to see us transition. But we try and talk to clients in a language they'll understand, and understand what clients care about, because obviously every business owner is different, and it's very important that advice is tailored to what they're interested in. So I work with a lot of businesses that in the sort of M&A space. I've got some big financial services consolidator at the moment, where I've been trained to read the sort of share purchase agreements, which is definitely not one of my favourite things to do, but I love doing the financial forecasting side of that and helping people sort of protect the money that they're going to get out of a sale, but also helping businesses build that data beforehand, which strengthens their position if they do want to sell. And I always think it's a nice journey along the way in that mindset, because it forces you to look at, as a business owner, what you're doing, do you need to be doing it, and how can you transition and improve your business. And then, yes, at A4G, we've been sort of 31 years together. When I started, there was 8 of us. There's now 75 of us, sort of across the sort of country and world. We've got a back office team in Durban, actually. So our finance and some of our team are in Durban, just because we found along the way that recruitment can be quite tricky sometimes in the UK. So we will tend to employ people wherever they are, and because we're quite a systemised business that does help leverage our team, it means we can easily do that. So we help some of our businesses put sort of job roles and things in place. So just to give you a bit of an idea, we are slightly different to kind of your traditional once-a-year accountant. We like to kind of get under the hood and help with anything we can help with, really.
Brilliant. Thank you. Well, looking forward to hearing more about that from you. Right. Emma, I'm actually
so as Gillian said, I'm not actually here to spread doom and gloom. It sounds like it, but I just wanted to put into perspective for all of you. We've had a lot of clients that have said that cash flow has become really, really tricky, and I don't think they've necessarily understood the exact financial implications of some of the things that have happened over the last few years, and just why. You hear very typically, I'm working harder, but I'm standing still. That is a really common phrase that's being thrown at us. And actually is why I've been involved in a lot of M&A work. I think a lot of people have hit the point where they've just had enough of how hard they're working. They've maybe reached a point in their life and they think enough's enough. So this just sets the scene really from what happened. So in April 2023, whilst corporation tax rose from 19% to 25%, it seems like only 6 percentage points. Obviously that is a 30% uplift in itself, which is significant on a bottom line. So it's squeezing every business's margins. So if you go to the next slide. Obviously, then in 2022, we had absolute rocket inflation at 10%, which is where, I'm sure all of you know, all the costs just shot through the roof and haven't come back down again. So everything has just got much, much harder. And when you talk to a lot of businesses, it's hard to pass those costs on. And then to the next. And then obviously there's still a further increase in inflation, so we've still got a 3% compound effect from that still. So go to the next one. So, and then obviously what they've done recently with minimum wage. So minimum wage in 2022 was £9.50 an hour for the lowest paid people, and now it's gone up to £12.71, which is a 34% increase in unskilled labour joining the workplace. When the unemployment figures are released either later this month or in August, we will see that the 18 to 22 category, there is a huge rise in unemployment because they've become really expensive, unfortunately. But I think what the bigger thing is actually how that impacts a business with layers of employees. The knock-on impact of that, the compound effect of then having to put everyone's salaries up, has been even more significant. And then we've also had the thresholds of national insurance change. So employers' national insurance has gone up from 13.8% to 15%, which doesn't sound quite so bad, but then they've dropped the threshold at the point you start paying it per employee from 8,840 to 5,000, which again is a 20% increase. So if you take a £25,000 salary, that's now costing £4,000 to £5,000 more a year for a business. So you can it's just to give you a bit of an idea that if you aren't looking at how you're pricing and the things that have impacted the business, which is why you are finding it hard, these are the things that have impacted businesses. It is why you're seeing a lot of consolidation as well in certain markets. So that's a 28% increase just to stand still. So it has been painful. I'm very, very sympathetic to businesses about how you try and pass that on, or how you try and find the efficiencies to manage that, which is exactly why now I think we're starting to see the impact of that on cash flow, because people tend to manage it within the first year. Quite often, if you've got a bad accountant, they didn't tell you about it till, it happened April 23, March 24 accounts, corp tax wasn't payable till Jan 25. That's a long time to be blissfully unaware of this as well. So we are now seeing that roll out in cash flow.
Well, I think everybody's feeling it as well.
Everyone.
And we were talking earlier about why we're not having these conversations with our clients. So if you're in construction, you're carrying out work for your clients, and they're not going to pay you for 60 days. Well, why is it a problem to have that conversation with them and say, I'm sure you've seen your costs go up. We all have seen this. This is not just a construction industry. This is everybody has had these. So really, we should be having that conversation. And we even talked about why we're not adding this into the cost of the job. So if you're pricing up a job and they're not going to pay you for 60 days, you want to win that job. You don't want to lose it. But you also have to finance it. So if you're going to go out and take on maybe something like Invoice Finance, then having those conversations with your clients to say, I'm going to have to put an extra 5% or whatever that's going to cost you on the job. I really want the job, but people are nervous about doing that. But I think the fact that everybody across the board is having the same issues, we've all had to, the cost of the wages have gone up for everybody, the corporation tax, all the taxes have gone up across the board. But having that conversation and that confidence to say, I really want to win your business, but I'm going to have to go out and finance this, and therefore I'm going to have to put an extra 5% on my invoices for you. Is that okay? And I don't. I know it's a scary thing to do.
I think people sometimes think you pluck your prices out of thin air, don't they? But I think actually knowing the impact that these things have had on your figures means you can have a much better conversation that helps educate your customers about what's happened just in the marketplace, and they're going to have that. If they don't have it from your competitors, then will your competitors even be able to complete jobs and things? Will they be able to fulfil work? Because at some point that will catch up with them. So I think it's just being transparent across the board, isn't it? And working with people on like a win-win mindset where everyone's got to win a little bit out of things.
Yeah. But also I think having a conversation with your accountant at an earlier stage to understand your own business and those costs within those days of I want this job done and you pluck a figure out of thin air. That doesn't happen anymore. You've got to, if you don't build those costs in and know what your costs are before you even quote, then you probably lose your profits somewhere along the way.
Can I just pick up, you mentioned a word there, you said that there was the fear of pushing prices up. I speak to a lot of customers and they will turn around and say, well, no, I can't increase my fees, it's impossible, I'm not allowed to. So why aren't you allowed to? You've got to try it. If you don't try it, you'll never realise that. And most businesses, based upon the works they're providing, the services they're given, they're going to do that work. They still want you to do that work. They trust you. They trust what you're doing. By putting it up by 5-10%, it's not going to make much of a difference.
Yeah. And
they know you, they trust you, they accept that
and we're
costs are
always
going up.
nervous about pricing, but I think if you say that to them, they go, oh, if they see the value in what you do.
But it's the fear of having that conversation.
I think it's important. So, So move on to talk a little bit about my world really, which is how we finance all of this, and that has changed a lot. As I said, 10 years ago, probably a massive amount of lending or borrowing to businesses was done through the bank. And I'm looking down here, we've got John Brooks, who works with me, who's 42 years now. I'm always scared to put the bank down because he did an amazing job for many, many years. But that person, that bank manager you had, is just not there anymore. And even we've got the banks coming to see us going, please can you bring our clients back to us because we don't have that bank manager. That is all gone. That was, I suppose, the vision I had 10 years ago when I thought about it. And actually about 25 years, yeah, almost 2 years ago now, there was a big change in the alternative funding market, which is anything that really sits below the high street bank, and started to lend more than what the high street bank actually does. And that scales, I don't believe, is ever going to tip back in the other direction. But the positive thing about that market is, one, we've got lots and lots of different products, which I'll talk about in a minute, to help for different necessities. But also, these lenders have invested in technology as well. Even if, I suppose Invoice Finance is a lot cleverer now.
Oh,
I used Invoice Finance when I had my copier business, where you had to print out all of your debtors.
Stick it in the post.
Oh, yeah. I wasn't that ancient, but
I remember that.
not far over. You got away with it for a few days. Now it's all connected. Everything's electronic. But actually, a lot of these fintechs now, these financial institutions, use technology to understand our business and produce kind of financial products that fit more within our business. And some of them are coming down in price. I mean, some of them, yes, are very, very expensive, and it's all relevant, which is what my job is, to understand what is it the client is trying to achieve. Invoice Finance is a great product, and we want to understand more about that, and it fits in a certain place, but not always. And sometimes actually we work with other funders as well as Invoice Finance, because it's not all fits one. So as you grow your business, you may need different types of finance. As I said, I'll talk about this a little bit later after we deal with the challenges. But actually because now obviously these bank managers, it's not available anymore. The brokerage world is which is my world that I live in, now nearly funds 70% of the lending out there. And you can Google, get a loan within minutes probably if you want to do that. But actually by using a broker, they can look at all sorts of different types of funding to make sure at different parts of that growth of your business that you're using the right funding and the right lenders. Because 9 times out of 10, if you're going to sign a contract, I can guarantee you probably don't read it. And as a business owner, I'll skim it, but I won't read it. And that's what a broker will do to make sure you're aware of getting the right funding for your business. So we'll talk a little bit later about the type of products as well. I'm going to pass back to you.
Thank you.
To tell us.
So we talked to lots of construction businesses. We also talked to lots of debtors as well, so the customers of our clients. And we do have these general conversations. So just a couple of bits that have been highlighted here. 27% say cash flow is key challenges facing their business. I thought it would be a bit higher than that personally. Yeah. I've got to be honest with you. But that was taken at a point in time. 65k on average is owed to them in unpaid invoices, which is absolutely incredible. Absolutely incredible. How a business is supporting their workforce, their staff, overheads when they are busy chasing down this debt is just beyond me. 65% report their customers are taking longer to pay invoices than a year ago. I think that's a feeling that everyone is sort of seeing out there. Slower payments, it means you can't take on more contracts, further works. And this is the big one, 10.5 hours a month, just a month chasing payment. So you may be successful in chasing that payment down, which would be brilliant. You might not be. So
It's the chain, isn't it? That is the issue.
Yeah.
We all have, I owe somebody else, they owe somebody else. And
Exactly.
it's that chain of if the guy at the top is not paying, then everybody else in that chain is going to.
Huge knock-on effect. And that's 10.5 hours that could be spent doing something else within the business. Bringing in new works, new contracts, etc. Oh, it was a bit
sorry.
I was a bit just at the side there. So within construction, everyone thinks that construction is a no-no in terms of funding. Typically, the banks will say, no, sorry, you've got construction in your name, off your trot. Some of the things that we do fund, contrary to what people might say, staged and partial payments. So if you are doing works and you're invoicing in a stage, then we will fund that stage. If you are putting in an application for payment, we will fund that application for payment. Whether it's part of a contract, we don't care. It's part of that contract, it doesn't make a difference to us. Whereas again, banks will say, no, it's not something we would look at. Again, traditional lenders aren't comfortable in that. I think there's an element that they don't understand the product, they don't understand the services that you're providing, and get a little bit nervous, so they say no. And challenges facing construction SMEs, combined with long projects, leaving the business exposed. So again, you could be doing works, billing, waiting 60 days, you put your next application in, you've got to wait another 60 days. So it's trying to fund that gap that you're finding.
Yeah, and I'm finding this year more so than ever before, people are looking to insure that debt.
Yeah.
So I don't know if anybody's ever insured, and actually one of the reasons I sold that photocopier business, I had 250,000 worth of bad debt because the recession was kicking in Ireland. The Celtic tiger was falling, as they called it, and I woke up in January and had 250,000 worth of bad debt. I didn't even know what bad debt was, to be quite honest. I've never experienced it. I never collected that money really, ever to this day. And I never insured that, and we're working on a case at the moment.
We are, yeah.
And quite a lot of the funders now are actually insisting that debt is insured. And I only realise now actually how important that is, and I didn't even know it existed in, that was 2009.
Yeah.
And that's really important as well, to make sure you know who your client is, because we can all be busy fools taking on and doing work for people, but if we're not going to get paid or be able to collect the money, then it can affect our business, and sometimes our business can go down, can go under. So that was actually the main reason I sold my business.
We were saying earlier, weren't we, that how it's still amazing how many businesses there's like this traditional you bill at the end of the month. And it's like, no, you bill when work's done, because if that moves the needle on when cash hits your bank account, it's really important. And how important that communication is with debtors really early, isn't it? Just keeping in touch. Remember, this is due in a few days. Oh, a few days past, this was due a few days ago. Whereas I think, it's funny, isn't it? Because I think invoicing and credit control becomes, it's seen like admin, but actually it is the sort of the lifeline of the business, isn't it? Keeping that going. So I would say for any of you, if you've not looked at your overall processes in a while, do walk them through, just to see what's going on.
So if somebody invoices on the 15th of the month and we're on a 30-day, they know they're going to get paid in 60. They're still going to get paid 15 days earlier than if they wait until the end of the month and they do all their invoicing.
Absolutely. And even a day now, if anything you can do to just move that cash a little bit further forward is critical. So I think it's definitely worth looking at. If you haven't had a look in a while, look at your process for billing, look at your process for, as Gillian said, negotiating. If you've got a big outlay of anything up front, should you be taking deposits? Should you be taking staged payments? Upon delivery and then completion and things. There's all sorts of things you can do, and there are actually automated credit control tools now. I mean, Xero's got a function where it will auto remind people, your invoice is due in 3 days. You can design the email. You can then chase so many days after it was due, and you can automate the basics of credit control. So I would say some of my best clients do all that, so that actually it frees them up earlier than needed for when things aren't being paid and it does need someone to step in. So it just means that you're not 10.5 hours just following up things that are 4 days old.
And I think Bibby will probably, if you talked about, you will actually finance against that stage payment.
Absolutely.
There's a lot of invoice finance companies that won't.
Yeah, they like the complete.
They like a completed job. Somebody signed a contract to say the job is complete. Yeah.
I was just thinking, I mean, I don't think we live in this world, but you know, having late pay interest and late payment, we don't use it because I don't think we want to upset clients.
Right.
But actually, I think if we all got used to doing that, then and it became just the kind of norm, then it might push people.
Legally, you can do it.
Yeah, you can do it.
Yeah.
And I do think if you've got tricky debtors and they're past, I think you've got the right to state you have the right to do it, and that might force earlier payment than if they think you're a pushover and you're not going to charge interest and you're going to let them have 6 months interest free. So you're absolutely right. I do think businesses, you can word it as politely as, you know, I don't want to have to be put in this situation, but I do have the legal rights to. You know, just shows customers that they're putting you in that situation. So you're absolutely right.
I think again, it's the fear of asking, the fear of putting it on there. It's like, well, if I put it on there, are they going to want to work with me again? Why not do it? Sorry.
I think it's kind of a norm in terms of legal contracts, because when I was working back in legal advisory, something we put in all our contracts, which is every weekly delay is about Bank of England interest rates.
But I think there's a fear factor of mentioning it, you're going to lose all your business. But I think if you do it in the right way, as I am legally allowed to, can we, you know, if you can't pay me, even if people said, oh, if you can't pay me, set up a payment plan now. I'd rather be getting regular money now than, as you say, waiting 6 months and not charging interest. And it is the compound effect of all of that, isn't it, on businesses?
And I think it's like anything. If you're not seen in their eye line chasing that invoice, they'll go, oh, they're fine. I'm not gonna. They're not going to ring you and go, oh, just sending you a payment. You've got to chase that down. It's so important.
Right, so I'm going to ask Emma, you're back on here, Emma, what are the top tips to understand around making your cash flow more efficient?
Yeah, well, so I definitely would. So year-end accounts, I think the one thing HMRC have ever done right, which you can put me on record for that, is making tax digital, where they've made all VAT registered businesses submit their VAT returns electronically, because it is forcing businesses to look at their accounts at least quarterly, or I'd like to think they are. More businesses to look at their stuff quarterly. Year-end accounts should just be a byproduct of everything you do during the year. So I would always say to businesses, at the very least, you should be having management accounts quarterly and using them as an opportunity. We refer to it in our office as turning stones. It's just trying to understand why things don't look quite right, what's going on, what's happening in your business. You know, is your margin dropping? Why is that? You know, what's going on? Are there inefficiencies? Are there errors? You know, what's costing you that margin? Because obviously the worst thing that I see is businesses that they only look at year-end accounts. They don't get year-end accounts in till sort of month 7 or 8 before the deadline, and then that information is so historic that it's much harder to recover from that damage. So management accounts, I mean, I would always say monthly. I am an accountant, I love numbers, but quarterly, you have to find the time to do it. So quarterly, definitely. I'd also say there's certain reports that I really love. Profit and loss is just your performance. Provided your balance sheet is right, your profit is right. Your balance sheet just tells you your position of where you are now. But there is a report that I make sure I design. It's actually an old Sage report that we've now put into Xero, because I love most things about Xero except this one report missing. It's your balance sheet movement report. Because most businesses get to the end of the year and they say, oh, this has happened to my balance sheet. Where is, you know, I'm paying this tax. Where's my profit? I don't have that money in my bank account. But your balance sheet movement report shows you where your cash is going. So it shows you if more money is tied up in debtors, if you're, you know, you've got more money tied up in debtors, but you're paying your creditors early, things like that. That will show you all of that. So a nice detailed broken down balance sheet and the balance sheet movement report just gives you that information really clearly about cash flow. I think often people think about cash flow and they think about all these sort of fancy dancy reports. And for a lot of my clients that try and do cash flow, they could spend 6 months trying to do a cash flow that's out of date. that actually if you get used to regularly reviewing your balance sheet movement report, you will get a feel for your cash flow. That's definitely the first place to start.
So, talk about my kind of part of the business, which is how we actually fund this. The alternative funding market, which we spoke about earlier, has many different products. Obviously, Invoice Finance, if you're a B2B business, you're raising an invoice for a product or a service that your product you're selling, a service. We can fund against your whole debtor book, or we can fund against some of your debtor book. The main reason people come to me for business lending is a growth stage. It's not always because they've got themselves into trouble. Yes, we do some debt consolidation, although I do think after all the COVID loans and all the liquidations and everything that's happened in the last couple of years, we're not doing as much debt consolidation, which is good. But it is about how do you fund that growth of your business moving forward. Putting obviously all the measures in place with your accountant is really important. But I think planning early is the most important, and people generally don't. It's normally a panic stage where, oh my God, I've got to pay my suppliers, because if I don't pay my suppliers, I'm not going to be able to continue with the job that I'm working on. And that's generally when people come to me. They also come to me, because at that stage they might need to take on more premises, buy more machinery, take on more staff as well. And as we all know, you've got to put all of that in place and pay for all that before you actually put your staff out the door to complete the job, so you can raise the invoice to actually pay for it. The other elements of finance is MBOs. I talked to some of the solicitors here tonight about, growing through acquisition. So how do we fund that as well? And also, as I said, debt consolidation. So just to give you an idea of some of the products that are on the market at the moment to help you, we get this technology, not happening. So we've got one of our products is a revolving cash flow product. So I don't know if any of you have used this. There's the secured and unsecured, and people always ask me, well, I have to sign a personal guarantee. Is that not secured? No, it's not. A secured lending product is actually, you've got a property, that could be a commercial property, it could be your home, it could be a buy-to-let portfolio, that we put a charge on, and then we put what we call like a hunting fund. We put an overdraft facility or a revolving cash flow facility in place. That you can draw down and use when you need within your business. And some of it, there's lots of different lenders now in that market, and most of them only charge when you actually use it, and some of them calculate it daily as well. So it's a very flexible fund that's available. We do have it unsecured as well, but normally if you're unsecured, you're looking at a more expensive funding. So let's say, for instance, you're a non-homeowner, and that's a big question our lenders ask, and a lot of my clients go, well, why is that relevant? What you've got to bear in mind with a funder is they've got to work out how they collect their money. So with an invoice finance facility, they effectively own your debtor book. If you go bust as a business, they'll go after your debtors and they'll pull back that money. Sometimes you'll help them do that because you want them to, because you want to pay it back, and that's their security. But if you think of it as just a general lender, how are they going to go out there? If you're a non-homeowner, they can't go after your home. Although I have to say, in nearly 10 years in business, thank God, I've never had a client lose their home. And I wouldn't encourage that, But if they're comfortable about their business, they've got a commercial property with a lot of equity in it, and they want to put a charge on that property so that they can have a big overdraft facility that they're actually only paying for when they use it, it's actually a really, really good facility. And just to give you an idea of a client of mine in the construction industry, they worked for Buckingham Palace doing all the they did all their maintenance there, and they were asked to do a one-off job at Hyde Park Barracks, which was actually to replace what they call the dung tunnel, which is a tunnel where all the poo goes down and onto a conveyor belt. But they needed $500,000 to buy the raw materials, but they were going to invoice $1.5 million for the job at the end of the day. But the whole job took 4 months before they ordered the raw materials, they installed the new kit, Then they raised their invoice, then it was 30 days. Although they were lucky it was the MOD, so it was 30 days that they were paid in. So it was a 4 to 5, it actually ended up being more like a 9-month window. This facility was fantastic because it was like 1.2% per month only on the funds that they used. So for me, it's about finding that right kind of facility that sits there. We also have now with the fintech, really, we've got a lot more line of credit. So effectively, again, a bit like an overdraft facility, but you draw the funds when you need it and you only pay when you use it. But actually, they offer you to pay that back in a term you would like to pay back in. So you decide, if you're working on a contract that is not going to complete in 6 months, you could pay that back in 6 months. So you make that decision on the day you draw the money. I want to pay it back in 1, 3, 6, 9 months. I actually call it the Klarna of the business world. So you make that decision. I want it now, but I want to pay it over a longer period. And we also have selective discounting, which I think you do a little bit of as well, don't you? I'll give you debtor, like a selective debtor.
Yeah, I mean, with us, it's more around making sure that we've got the ability to fund the bulk of what's currently outstanding. But if you've got a customer that's paying within 7 days, 10 days, then we can effectively exclude it from that agreement. So it's a form of selective.
Yeah. So selective discounting is where you choose one debtor. So if you kind of win a contract, but you don't want to lend against your whole debtor book because everybody else plays quite well and that's all running fine. So I'll give you an idea of one of my clients. CBRE was their customer, who generally pay in about 60 days, but they're a nice client to have. And they wanted to win those contracts, but there was no way that they could fund that. So we got them selective discounting where they only fund against that one debtor. So every invoice that they raise for that debtor, they use Invoice Finance. They can draw down 85% within hours of raising that invoice, and they've got then the cash flow to make sure that they complete the job, pay the wages, and pay for all the raw materials and stock and everything that they need. Asset finance, which I think most of you know, we're buying an asset, machinery, vans, we do that as well. And also property finance, but we're not really talking about property finance here tonight.
For construction invoice finance, which is what we specialise in, we will fund against stages, applications for payment, whether that be on a certified or uncertified basis. So what we mean by that is you've done some work, you've invoiced for it, or you put your application in. You sometimes have to wait for the payment certificate to come from your customer, and then we fund it against, then we fund it against what we call certified, and here it is. Sleep there, baby. So yes, we will fund against certified, which means that your customer has gone, you can invoice for £2,500, there we go, and you can go against that certified application. There are situations where you put your application in, but you want funding at that point that's not been certified, and there's that whole raft of a process to go through before it gets certified. So we do it as an uncertified. So at the point you put your certificate, your application in, we need no certificates. You can draw money against that uncertified application. So each business is very different. You might want cash at that front point, or you're quite happy to wait for it to be agreed, certified by your customer, and then you draw against that. So there are a couple of different ways of doing that. Each way really does improve the way you're running your business, because you've got access to cash, whether at the front end or on that certified basis. So as I say, some of the key benefits: we provide funding against certified, uncertified. It's normally within 24 hours, so you stick your application in, providing we've done all the checks on your customers, which we would have done before that, because you would have told us who you're billing. You can draw against that within the 24-hour period. The flexible funding of growth for a business. So we will put facility limits in to mirror your business. So you might say we want a 100,000 limit put in place, which is like an overdraft, but it's against your invoices or applications you're putting in. You might find that in 6 months' time, business has grown to a point where you've won more contracts and you need that support. So that's where the flexible funding comes in. we'll review what you've got, we'll see who your customers are, and then we'll look to increase that limit for you. So it's not a stuck in stone, that's it. Invoice Finance is there to aid that growth that you've got in with the business. Gillian mentioned about the protection, and it is rife in construction. Probably one of the worst sectors in terms of bad debt at the moment. So we would always encourage our customers to look at bad debt protection, which protects you should your customer go bust. We would always check those customers beforehand. So I would always encourage a new client to turn around to us and say, look, I'm going to be working with ABC Limited in the next month or so. Would you mind me doing a little bit of a check on them? We'll check them, we'll check the protection that we've got in place, and we'll be brutally honest, to be honest. If we're saying, don't touch them, we mean don't touch them. So you might then work on a pro forma basis where you're invoicing for everything you're going to do. So we're not only there to make cash available and protect the business, we'll also give you a little bit of guidance.
I think that's the key, because a lot of invoice finance companies don't do that. They just want to lend against you. You know, but actually, as a business owner, you don't realise how volatile you are sometimes. You're doing the work, you're paying your staff, and your client goes bust tomorrow, and you're stuffed.
And we deal with a lot of main contractors. So some of the big boys will pick the phone up to us and say, look, just to let you know, we've heard some rumbles about this client, that client, just be a bit careful. Prime example was ISG. So when ISG went, we knew about that about 18 months before anyone else. And we were just notifying our clients, just saying, look, we want you to reduce your liabilities with that particular debtor. And then they went bust. So we're not only there to make cash available, which we are, because everyone wants the cash, but it's just making sure that we're doing that in a sensible environment for you.
So is there ever an instance where you say, we'll take on this invoice finance, but we're not going to invoice, we're not going to lend against that? Yeah.
So again, that's where we won't class it as selective, but we'll exclude that customer from the arrangement. And you might turn around and say, I've known them for 100 years, we barbecue with them, we go on holiday with them, they're not going to let us down. So you can actually fund, you've come across it before.
9 out of 10 times they do.
Correct.
Because if it's food on my table versus food on yours, it's amazing how quickly those friendships can die.
Correct. So we will be there to support and give that guidance. But if you're quite happy to work with them outside the arrangement, then who are we to tell you?
It's a good
different?
discipline, isn't it? Like to have a facility that, I think for any business, to be credit checking the people you're working
100%.
with. And I know it's one of the things that we say to clients is if there's a dip in your performance, or suddenly you've got significantly less net current assets, we will say to clients, this is what is going to happen when you file your accounts. This is what you're telling the outside world, is that you are struggling, or you've had a worse year, or because you need to be able to manage that communication if it's your bad performance versus if actually someone you're working with has that. You need to be able to say to them, actually, your credit rating's dropped. Like, you're going to need to put a deposit down this time, or
against that fear of asking.
Yeah,
it's detriment to your business.
and I think on the other side is the concentration level, because we're working on a client at the moment, which is very important in invoice finance as well. Is if all your eggs are in one basket, like one of my clients at the moment, 75% of his invoices are with the one customer. Now there's 20 departments in there, so he's pushing back and saying, I'm not going to lose 20 jobs in one. We've looked at it's a really healthy, it's pharmaceutical as well, isn't it? It's a very healthy business. But if you are considering invoice finance in your business, but a big concentration of your business is one client, then that's going to have an impact as well on the amount of money that you can borrow. And also, that's probably where it's more important to insure the debt as well.
Absolutely.
Because we just don't know. Look at lockdown, look at COVID.
But I'd be interested to know if they know what that loss might cost. So if I've got a client that I track, they're big, over about 70% of their turnover is from one customer. But we have a disaster plan.
Right.
But we know how much of their profit they lose. It's less profitable, actually, the work, because they've driven down margins over the time. But we know what would happen if that was lost. We know exactly what we'd need to do. you know, in terms of the business.
Right, okay.
And sometimes knowing that is quite powerful.
Yeah. That's really important.
Just one bit I just wanted to cover off, which was the last point there, which was the confidential facilities. So a lot of people who are entering into invoice finance will sit there and go, don't want my customers knowing about you guys. It's not going to look good. It's not going to look good. So again, if you've got the mechanisms in place, you've got the individuals within your business that chase invoices, you've got accounts packages like you mentioned, Xero, and you can monitor that, then we're quite comfortable in looking at putting a confidential facility in. It's more relevant within construction because within contracts that we'll look through and we'll help you through, those contracts will state sometimes you cannot use an invoice finance company
Right.
to support your facility. Well, if you put a confidential facility in, they're none the wiser.
Right. Okay.
So again, in construction, we do a lot more within that confidential space.
Right, so that
rather-
means that their customer doesn't know that they're using
Correct,
Invoice Finance.
yeah. Whereas if it was what we call a factoring facility, you may have come across terminology before, we appear on the bottom of the invoice and your customer knows of our involvement. But in particular in construction, we tend
And
to
also
look at
with factoring, generally you will ring the client to collect the debt.
Yeah, yeah.
Where with invoice discounting, the customer themselves will collect the debt.
Yeah.
So that's the main, people ask me that all the time. Sometimes with confidential factoring or confidential invoice discounting, the lender will still collect the debt, but they will collect it in your name as opposed to ringing and saying it's Bibby. They will ring and
Correct.
say that they're your name so that it's confidential.
So do you not put it at a company's house? It's not secured in any way at a company's house, so they wouldn't be able to look and say.
Yes,
There's a
you're
charge.
right. So there would be a charge registered at company's house because we register a debenture there because
Yeah.
that's our main security. But the way we word it, it looks as though it's because obviously we do asset finance as well. So a lot of customers that would look at that will say, well, no, I've got a bit of machinery, I've got a bit of kit, and it falls under the Bibby name within that debenture. Good point, that. Good point.
Yeah, I didn't even thought of that myself. Thank you.